All right. So I'm sorry. I ask that question again to make sure I understand it.
Okay, so if we're using on the Carter challenge, we use flip on the fourth, use the fourth piece our dot to move our stop, and then once it picks up the BB mean, we just follow that.
Okay. So
If
the exit strategy you're talking about is one of 5 or 6 different possible ones. That's the Wu-Wei exit, which is the you leave the stop in place until the fourth PSAR dot goes past the entry. That's one particular method of exiting. Um, it could be, it's not a bad one. I don't mind using it, but it's not the only one we can use. So just want to make a point of clarification there. Um, if you guys send me these questions ahead of time, and that's the snarky thing I was trying to say before. If you send me those questions ahead of time, I can have the charts and examples and everything already prepared. I don't have time to do it now to go find the particular
okay, cool.
materials. But in order for me to give you the best prepared answer, if you send me the questions ahead of time, I can give you a more concise answer than the one I'm about to give you.
Okay.
So go ahead. I'm sorry. I didn't mean to interrupt. Go ahead. Start over with the question.
Oh, okay. So if we using the Wu-Wei exit, and we do, and when we start doing the Carter challenge,
Yeah.
Do we stick to the Carter challenge is designed to get the monkey under control, right? So
Yeah. The Kata challenge is designed to give you a concise set of rules to play only one particular pattern with one chosen exit strategy on a single symbol to see if you can execute, to see what it feels like to execute purely mechanically, and also to acquaint you with some of the issues that come up that your mind notices while you're making the trades. Like, I have these rules and I'm supposed to follow them, but my monkey mind sees some other things. What should I do about those? Well, in the Kata challenge, what you're specifically supposed to do is simply to notice every single instance where your mind leaps to say, hey, well, what if I tried this? And would, because what we want to do is use that as a reason to understand how our mind works and to go look for the source of the inspiration, and then also to see what it feels like to just be in a trade, managing it according to rules, and then what to do when an impulse happens. And what we're supposed to do in the Kata challenge is simply to note that in our trading journal that this thought occurred to me. And then when we do the after action review after a couple days or a week or 2 weeks, we start noticing all the things that we keep coming back to. And it may be that there were enough instances where we saw an opportunity that each little answer is worth pursuing based on the frequency of questioning or the size of the move that we didn't take. And it gives us the ability to collect data on observations without trying to answer every question on the first time we see some divergent piece of price action. So that's really the purpose of the Kata challenge. After 30 days of doing that, as you try to answer those questions yourself on the basis of, well, how did you study to answer that particular question? Then what we've done is we've created the mind of a researcher in you to start learning how to ask those questions, look for specific data to answer it, and then formulate a proposed answer to your own question so that you begin to develop the mindset and the eye of a coach and a researcher. In that way, the locus of control, the responsibility for adjusting the rules, resides with the trader. And it helps break that cycle of dependency. We're saying, well, I'm not sure what to do here, so let me just ask the system owner, how do they do it? And we may or may not know why they did it or what their data set was. But in every case where we accept an answer from outside research, there's a certain degree of freedom that hits that makes us beholden to others and never really satisfies the inside of our mind. And I want to draw a diagram on that, because this is I actually wrote this piece in the book that we're. I will get to answer your specific question in a minute, but I want to make sure that I answer this one um, correctly right now. Let me find my annotation here. Annotate. Oh, I got to share the screen. All right. So what we're trying to do here. Oh, come on. Now it should be annotating for me. There we go. Yeah. All right. So the first thing that we notice is that there was some kind of a question or an aha moment or an insight happened. And what we want to do first is empty our mind. Try to collect all of that energy and put it all inside something like a research question that I want to ask a question about. And from that, I want to do divergent thinking, meaning that I'm gonna look widely for information. And then at some point, when I feel like I've gathered enough information, I'm going to come back and converge, and then I'm going to reflect on it and think, all right, what does all that information and analysis tell me? And then, as an answer to that, I'm going to come up with the next thing to do. And so, as I'm reflecting, I may end up generating, well, here's a bunch of things that I could do. Which one of those rises to the top to be the next thing to do? And then I'm going to prepare. And then when I'm done preparing, I'm going to make a claim that sounds exactly like this. I am ready to work, period. I am ready to work, period. And when you say that out loud, it satisfies your inner monkey that says, yes, I am prepared enough to do the work and do the investigation. And from that, I'm going to say, let's go. We're going to take some energy and off we go. So what we're really doing is, in all the way up into here, what we were trying to do is adopt the mindset of a coach and a researcher in order to take ownership of the idea of the system. So if I'm here in the mind of a trader and I'm borrowing this guy's rules, I'm adopting them and I bring it into my little space. And then something happens and I say, hey, let me go outside myself and get my question answered, and then adjust the rule set and bring it back in. I'm relying on things outside of my own self. I am beholden to, I don't have information independence. So what I really want you to do would be to collect data on a very particular question, things that you notice. And why do I think that it's a thing that should be investigated? Now, it is also fair to say, hey, since I wrote those rules and I have, 10,000 experiences in trading that thing, hey, what is it like from your perspective? What is it that you see? And so I'm going to answer the question. But far more important than the answer to that particular question is the idea of the mindset of the independent trader that we want to create here. Because if I get hit by a train tomorrow and you haven't internalized this process, then all you have are the external answers to the questions that people have asked me before, but no further explanation. And now it's like, well, where's the authority to answer that question? Why should I feel confident in that answer? If we can learn to bring this mindset, all this stuff, inside ourselves, it's painful at first, and it means we can only focus on the things we're going to focus on. But what you end up getting out of this is that at some point you realize that you have done the due diligence and that you know what the next thing to do is, and you know the evidence in support of taking that behavior, and that will actually create emotional resilience for you at the time of decision, because you're not asking questions. I'm wondering what I should really do here. And they say, well, I don't know, so I'm just going to do something. That's not a stable base upon which to build decisions. I'm always going to say, if I don't know what to do, get out of the trade. That's my exit rule. If I don't know what I'm supposed to do, then I'm supposed to exit, because I haven't figured out what the risk to reward. Well, so what I actually do is say, I made some entry at this time, and now time has moved to T plus 1 or whenever it is. And now I'm holding the price here, and there is some price below this which tells me that that this is no longer any good. And I've noticed up here there is some reasonable move from this price that wouldn't be irrational, but if it goes below this other price, then this ain't happening and it's time to exit. So at every kind of moment on the curve, I'm always making that kind of reframing judgment. So if I do that, then I can answer all of the questions, of which there's really only one question. Where should my stop be now that I'm in it? And if I'm not in it, the question is, what is my trade frame now? Price is right here. Well, here's how we do that. If price was right here and you have some context over here of previous price action, and maybe we just exited and we say, all right, now we're out of that trade. We're in the emotional zero state. You tell me if this thing starts going up, where you feel the impulse to enter. And let's say, oh, I feel like I should be entering right there. Well, then we wonder why did your inner monkey want to enter there and maybe not over here? And then we go the same way the other way. If I was in this position and I saw it starting to go down, at what price am I confident that I should be short? And should I be short? Should I be short? Oh, I should be short right there. Well, what we've just done is that we've gone from a position of complete uncertainty, and now what we've been able to do is actually draw the trade frame that reflects my inner certainty and uncertainty threshold, right? So what I actually have by doing that exercise is that I've created a yellow zone in here where it's not clear exactly what I should do. But because I went through that exercise, I know that I'm supposed to be short right there, and I know that I'm supposed to be long right there. And now I can say that's equal to 1R. And then I can say, is there 2 of those to the downside? Are there 2 of those to the upside? If there are, then I actually have a trade frame that can go in either direction. It may be that I don't have 2 to 1 to the upside. So in that position, I can't even go long, but I can go short. So once we come to that conclusion, you now notice that what we've done through analysis and the structured process of trade framing is that we've been able to go from the moment of maximum uncertainty, I get no idea what I should be doing, to one where I've consulted my inner guide or my inner monkey, or what that combination of art and science that's inside me, and I've at least identified where my own sense of certainty is in both directions. And then I can use my rational mind to determine, in the time that's still available in this session, is it reasonable for it to go 2 units of reward in that direction if it breaches this level? Okay, if so, then I have a trade frame in that direction. And if I can do it in both directions, that's really good, because now what I have is something like a compound critical state. Well, once I've done that, and I'm now in that yellow zone, I've got my initial calibration of what I think is going on. And let's just suppose that I've decided that actually I can trade it in both directions. Because when I did my first initial estimate, I saw that there was 2 to 1 reward to risk in each direction. It now may be that as I start looking at this thing more and more carefully, because price is just noodling around inside here in the yellow zone and there's no trade, it may be that that thing actually did this. And now I notice, I said, I think I could actually adjust my mechanical entry to there and to here, because it now feels like it's locked into this little compression zone. And then I can look around and say, hey, where are the Bollinger Bands? Oh, the Bollinger Bands are collapsing. And now they've come into this really tight little range. And now all I have is, I've noticed that the yellow zone has gotten smaller. And it turns out that these two outside reasonable price limits are still there by the fact that I'm able to get impulse control in hand and just continue to study this during time. Now my R looks like this, and now maybe instead of 2-1, I have 4-1. And it might even be that at those original price levels, I could add a second position. Or at least by the time it breaks out of those two, I should be able to get my risk out. So now what I've done is I've gone from a moment of maximum uncertainty to a point where I have a refined trade frame. That little process right there is 100% of what's important about our foundations of trading. Now we have some specific rules and indicators and patterns to follow that we can use as templates to just slap it on there and get used to standard work. But the main point of those standard trade frame questions is to learn how to go from a moment of I'm in maximum uncertainty. Maybe I exited a trade, and now I'm saying, is there another trade, or how long should I wait, or what should I do? Well, if I don't know what to do, then what I should do is go through that process to start refining the trade frame until I do have some certainty. And until I have that trade frame in hand, I'm not supposed to do anything except study and stalk the trade. So far, so good?
Yep.
Okay, so now we're going to talk about the Kata 2 challenge. And just as sort of a, let's imagine that we had some kind of sideways quiet channel with the R10, and then something happened and it broke down and it did this. So there was probably some kind of like a collapsing dragon or some reason to get in, or we could have gotten in, even if we didn't get in. But in retrospect, we can say, there was a clear collapsing dragon. And look, that thing had a great big, long, unambiguous move to the downside. It made a clear V bottom in the R10. It crossed his own little baby dragon, which is a 3-period simple moving average of the R10. It will have at some point crossed the dragon. And now what I have is I have 3 criteria for the SSC. First, it was a harsh winter, an unambiguous move down. Then a clear bottom in the R10. Now, the way the R10 works is that always has a V bottom, whereas simple moving averages tend to have smooth, orderly turns like this. Because of the way the R10 is computed, it makes V bottoms. So there's always an unambiguous point where that thing was going down, but now it's going up. So the SSC is that first move where it crosses the dragon. So this is criteria 1, harsh winter. 2, R10 bottoms out. 3, you get the RLXD, the regression line has crossed the dragon. And now it goes up a distance. It comes back. I should draw that in blue. I'm sorry. So the R10 goes up some distance, doesn't matter how far, comes down, and now makes another cross. Now, on this move from the peak of the RL10 to the bottom peak of the RL10, I may or may not have exited. It, in terms of the Kata 2 challenge, it doesn't really matter if you took the SSC or not, and if you did, whether you got out or not. All we're looking for in the Kata 2 was that there was what we would classify as a successful SSC, meaning that I got an entry in the usual way and it moved up far enough that I could have made money on the trade or at least not lost. Check or hold?
Check.
So now I have some observable pullback, and I know there's a pullback because the slope of the R10 comes to a peak. It's a point, it's a V top. And now it comes down and now it's a V bottom. Now what I have is I can see a higher low in the bottom as defined by the lowest point of the R10. So now my entry on the Kata 2 challenge looks like it is normal to see the dragon has now moved back up like this. And the R10 will cross the dragon the second time on this leg. And that will usually, normally, almost always occur below the peak of the RL10. And so that's why we call this little territory in here between the bottom of the R10 and the top of the R10, we call that the pocket, because this is usually a place of quiet and indecision and monkeying around. And it's not until that thing breaks north of the peak of the R10 that it has cleared all the resistance. And now very clearly what's happening is that new buying pressure came into this, and that thing is driving that thing north. And then it's unambiguous, it's going. So we say any entry that's north of this peak of the R10 is going to be an emerging dragon, because now this thing looks like this, and he's rocking and rolling, and he feels like a dragon. There's his little fangs, and off he goes. So he has emerged from the previous peak. Well, we know that little move can be so explosive that it's worth our while to try to get this entry inside this little pocket in here, if I can. Inside that pocket, which is between the bottom peak of that R10 and before it breaks north of that previous peak, somewhere in that little virtuous triangle, it's going to cross the dragon the second time, the second RLXD. So that's what makes it a Kata 2. That and that alone. Now, if I have a Kata 2 entry, the reason I was being such a schmuck before about which exit, so there's about 5 different exits that I might use to manage that particular trade. Like I could do just trail 1R. I could use follow the PSAR. So wherever the PSAR dots are, just let the PSAR be my guide. I could use the southern skin of the dragon, southern skin dragon. Now, what does that look like? Well, what that looks like is the idea that the dragon, in these rising tides, looks something like this. That acts as a noise buffer on price. And what will happen is that if I had, price did this and then it crossed, and then that would typically be seen as a Kata 2, because there was probably some SSC and then the higher low, and then he crossed the dragon here. And that's usually a reinforcement of the original trend, that this thing should just keep going. And as long as the power that drove it up in the first place and got it across, as long as that trend is in play and the buyers keep coming in and hitting it, that southern skin of the dragon, it's not unreasonable to treat that as my stop. That is usually north of where the PSAR flip will probably look like this. And you'll get some little box between and the PSAR will normally be like this. The southern skin of the dragon is normally closer to price than the PSAR. And then on a good longer trend of maybe 10 bars or longer, that whole move will be out of the river, and you'll see the edge of the Bollinger Band +1 is like usually in here. So there's almost these like 3 layers or even 4 layers. Like if this turned out to be a really extraordinary move and there was a big peak and then it starts failing, you have quite often seen me take the northern skin of the dragon as the exit. So on this one, if it was up here and then just started coming back, I might take the exit at the northern skin of the dragon, especially if this was a parabolic move, or I might take the southern skin of the dragon, or I might take the PSAR, or I might take the edge of the river, or I might have just taken a whatever that initial wrist box was, and then just trailed the whole move up. So there's a lot of different ways that I can do that. It turns out that the Wu-Wei exit is not one of the exits that we use for the Kata 2 at all. The Wu-Wei exit is appropriate for that very first move, the SSC. And now here's why. First, let me say, were there any questions on that little discussion so far? Hearing none, I'm going to say, look, so there was a harsh winter, and that means that the primary trend is down. That means that even though this thing bottomed out and started to come up and we had it cross the dragon, and maybe somewhere in here we got our entry on the far side of the dragon, and because of the way the PSAR is drawn, the PSAR, when it flips, always equals exactly where the bottom peak of the R10 was. And if I use that as my hypothesis, I said, look, if this thing is going to work, it will never go back and revisit this previous trend. We're saying that the hypothesis is that this thing is going to move in this direction now. For that hypothesis, the price that proves that hypothesis wrong would be a resumption of the previous trend. What's the first price that tells me that this previous trend may have started it? Well, it has to be, I have to go to the bottom of it and say there's now a new price lower than the previous bottom. And that's the argument for the collapsing dragon. And when that happens, we love that one. That's my favorite pattern, precisely because the previous trend was abnormally strong to the downside. That was an abnormally strong downward move. My favorite trade then is to just get back on the biggest previous trend, especially when it's fear, because that's going to move further and faster than anything else. That's why that's my favorite one. But it just so happens that the SSC wins often enough that we can make that positive expectancy. But I don't believe in it, and I would rather take it and then fail into the collapsing dragon than try to fight this thing all the way up. Because if the SSC fails, that thing is a huge downward move right away. If the SSC works, this thing is much more likely to be like this. And it may get back to the previous price level, but it will normally, this will happen in about 1/3 of the time, and it will take 3 units of that time for this thing to fight its way north, because the movements are not symmetrical. It's the phenomenon of climbing up the steps and jumping out the window. So the moves to the downside in the symbols we trade, these happen quick, fast, and in a hurry. And the moves to the upside take longer to unfold because greed is not quite as powerful as fear. And after each one of these little moves up, and then it starts to hesitate, somebody that bought it back here on the SSC is taking his exit so that he can preserve that little win that he got. He wants to win that. So he has gone from buy and hold to exiting the trade. That little selling pressure now gives the short side an argument that, hey, maybe this thing's going to fail. And everybody that was short from up in here wants to short this little dip. So an SSC that works is not a known thing. That is a very vulnerable trade. But the longer that thing keeps working on these little buy on the dips and it keeps going up, the stronger and stronger the confidence is on the buy side. And that means that the kata 2, that happens after the SSC, so this was your SSC, he comes up and now there's a kata 2. This little kata 2 succeeds more than the SSC succeeds because there's already one successful leg up. And the argument for the kata 2 is that as long as that R10 made a higher low, then we actually have evidence that buyers started coming in here instead of waiting for it to come all the way down here, because they have a belief that thing's going to keep going. So they don't want to take the risk of hoping it's going to come all the way back up here. Somebody started buying it and they said, I got to get in. I can't wait for the better entry. I have to get it now here instead of here. That making sense? So the kata 2 entry builds on the fact that there was a successful SSC. And then I'm going to pick one of the 5 exits on the initial trade in order to manage it. Now, what will happen is that as that price goes up, so here's your little kata 2. This price might go, from this point where you got to, let's say I entered, I'm going to say I entered right here. And I'm going to say that my stop was right here. So I had my little risk box and there's my stop. And maybe this thing moved up far enough to here. And I realized, I can now move my stop to no lose plus dinner for 2. And when I compare that to the original entry, I now have locked in that little wedge, that no lose plus dinner for 2. Once I do that, psychologically, I am in a much better place because I'm never going to lose money on that trade. Now it's simply a science project to see how much I might earn from that set of rules. So I'm almost disinterested and I just have my lab coat on and I'm just taking notes. So now from this moment, once I'm in no lose plus dinner for 2, I can now start thinking of my thresholds of exits in this trade, something like this. From the moment that I entered, my worst possible exit was going to be -1. And maybe my next worst exit is going to be no lose plus dinner for 2. But maybe if I was using a trailing stop, I might be able to get some intermediate stop. I still lost money, but I didn't lose a full R. But as soon as I can move my stop to no lose plus dinner for 2, my psychology changes. Now what I want to know is, what is my average win? Because I've traded this thing 30 times. And I studied my histogram of winners. And I say, for the winning trades that I have, what was the size of the average win in terms of R? So if that's my R, maybe it's 0.7. Maybe 0.7R is my average win. Now what I care about is this idea. If price moves north of an average win, that's great. I have an above average win. Now if that starts to fail, I don't want to be in a psychologically, I don't want to be in a position where an above average win, I let it become a below average win. That would just hurt my feelings, because I did have a choice of turning an above average win to at least an average win. Now, this has nothing to do with where the position of price within the river or the dragon or anything like that. It has nothing to do with that. It has everything to do with the fact that I have studied a standard work on this trade pattern, and I have enough data that I can now compute my average win. And now if I'm in the region of an above average win, I want to raise my stop to at least an average win. Then I don't hurt my own feelings. Yeah, I'll tell you what a really bad feeling is. Have an above average win, and for any reasons, any combination of reasons, you let that thing come down and become a losing trade. That will absolutely ruin your day. And it should. Don't let that happen. Now, if I keep going up the stack, I'm gonna get to the 2R battle drill idea. When I first framed that trade, and I thought that I could get long here, and I thought that this was the price that would tell me that hypothesis had failed, I looked at this and I said, there is my 1R. And maybe I have some reasons to believe that I could get to this price level, and maybe that gives me a 2-to-1 reward to risk ratio at some level. Check or hold. And let's suppose that my average win was 0.7. I'm gonna draw this at 1, 1.5, and 2. Okay, so I'm at 1, 1.5, and 2. The reason I even put this trade on was because I had a reason to believe that a 2R win, it was not crazy. Like, I believe that it could get to 2R before it ever violated my 1R stop. So that's my hypothesis. If I'm right, then I should have a positive expectancy system, and then I can go take a look at all my wins. I can figure out where my average win. I could see, I wonder how many times I got to 2R. Hey, what if I got almost to 2R? I got to $1.99 and then it started to fail. If it had gone to 2R and I just cashed that trade and I had a 2R win, I'd be really happy, especially if my average win was 0.7. And now I actually got the 2R that I framed and envisioned. That's 3 times my normal win. So what if I only got to 1.99 and there's the magic 2, but price didn't quite get up there and then started to fail? Now what I'm looking at is I'd have been happy if I exited exactly at 2 because I made 3 times my average win. But now I'm starting to give back those open gains. How far down the stack do I want to go? Am I going to let it come all the way back to an average win? No, I'm not going to do that, because I would have given up minus 1.3 of win in hand, which is, practically 2, all the way down to 0.7. I would have given back 1.3, which is more than the original risk I even took. Now, how silly does that sound? I'm holding a win that is 3 times larger than my average win, but I gave back enough to cover 2 average wins. That just sounds nuts. So until you have enough performance data, you can't even do this kind of analysis yet. Now, one of the things that we can do is now take a look at the descriptive statistics, descriptive stats, which give us general indications about what normal price moves from that level could be. And now those can be useful. They're not as important as making cast iron rules or stainless steel rules about how to preserve those hard-won profits and when to start making those measured moves to lock in certain pieces of these moves. I will tell you, if that trade ever gets past 2R, I mean, that's just like a completely different ballgame. Because what happened on a greater than 2R win was you had this horrible sell-off, and you framed your little, it moved up a little bit. So now you framed your trade, and you said it gave me one leg up, so I'm in, 2 legs up, and 3 legs up. Now I'm at 2R, and the buyers were so strong that they came in and bought it and pushed it all the way up to 2R. And the all of these guys that pushed it all the way down lost that fight. And if this thing keeps going beyond 2R, what that really means is that on the next higher time frame, that's really just one leg on the next higher time frame. And now those guys are buying it for a second leg and maybe a third leg. And now what turned out to be just a 2R win could be a 5, 6, 7, 8R win. And maybe even the guys after that come in and this thing goes off to the races. All of that started with on our tiny little time frame down here where we saw the potential of an SSC and we saw a couple COTA 2s. And usually it just gives us one leg and then it fails. And the reason that it fails was it came back to that earlier feature, which was that there was a huge downward, unambiguous, harsh winter. And until there's really an extraordinary move of that same significance, this is always going to be the move that the previous guys are going to try to short on the dips. How far are they going to let you go up the stack before they come in and start pounding it to the downside? So what you have to remember is when you get to 2R and it starts to go, you actually just became vulnerable to the short sellers on the next higher time frame who are coming in with even more money to beat this thing down further. And that's why if that 2R win doesn't immediately start moving, I'm very inclined just to take it before it starts moving against me. So I needed to say all that in order to say, on the particular question you asked me, on the COTA 2, I'm going to say something, I think, like this. Depending on, and there's my entry, depending on how far and how fast this thing moved up, was it a rocket ship to the top? And that thing that it moved so fast that it maybe it left the river like this. Maybe here's the river. And then here's the floodplain, Z2, and maybe here's Z3. And maybe that thing went up and went 2 little dragon horns. It did a peak, and then it opened and started to come back down, and now it's inside the Z3. Instantly sell. And if it's at Z plus 3, I know that there's one standard deviation to Z2, to Z1, and to the Bollinger Band mean. And I can see if I can put one risk box on that from here. That's, by the way, the Anderson regression line stretch idea. Because now I have a reason to believe that a simple reversion to the mean trade, which is the least surprising move of all, especially on a sell-off, because that's fear, and especially if the previous move was a massive downward move, that's going to look in retrospect like just one big whale came in with a pile of money, and that was enough to distort this market and move it all the way up, and then nobody else came in to buy it, and then it stalled beyond Z3, and now is just failing. The move back to the Bollinger Band mean is normal, and so I can just frame that as a stop and reverse with a 3-to-1 win, and let's see. It wouldn't surprise me if it got back to the Bollinger Band mean and then started to roll back up. Because now the strong move was this move from Z minus something all the way up to Z3. And in retrospect, I will have seen the R10 bottomed out, and then maybe this starts going up. Now I have a Kata 2 in here. So this looks like what, a big down, big up, and you start getting this stuff. And once the buyers start winning, this thing starts to accelerate to the upside. That's where these little descriptive statistics can give us some insights about frameable trades. Now, on a move that started off as an SSC, where it was a harsh winner, and then it was a Kata 2 and starts to fail, because this was a harsh winner, I'm inclined to take that here and then add a second position with a collapsing dragon. But if the previous move looked like this, it was a nice summer move, and then it turned into the fall and did this. I really don't want to short that, because what I have is something like, I probably have all of these things. I'm waiting to find it. Where's it going to make its recovery? And I want to see it stall. And as soon as it starts to move up, I'm ready to get in right away. Like, I don't want to wait for it to break above this, because I want to capture that move so that when I have my very tight little stop, as soon as price breaks north, I'm moving my stop to here. Instead of chasing the entry with nothing, I already may have 1 or 2 R in hand. But if I get this thing long and it can't break above this, but now starts failing this way, now it's all bets on. Now what I have is a Kata 2 to the downside. Why? Because I had a high and now a lower high, and now it broke through the bottom of the dragon, or the bottom of the R10. That's like a Kata 2 combined with a collapsing dragon. This is my favorite pattern of all, where I can already see the lower highs, and it broke through the low of that previous support level. That means the next support level is my new target, and then the next support level is my new target, and then this last support level is my new target. Because this thing can fail all the way back to here much faster than it took grinding its way to the north, because the pattern is climb up the steps, fall out the window. That's the move I love, because that's the collapsing dragon. All of this is predicated on the idea that way back in the beginning of this discussion was that when price is doing something, what I have to do is figure out where could it easily go to in both directions with a significant move. If I start tracking, if it starts going north, where do I want to get? Where is my impulse to get long? Or better yet, instead of an impulse, where is a standard entry like a Kata 2 or an emerging dragon that lets me get in with a mechanical rule that I could code? Check. And then where could I, if it starts to fail from here, where could I get in, not by impulse, but maybe first by impulse, so I can check my inner trader, but where is it based on like a collapsing dragon or something like that? And now what I have is a very mechanically calibrated, a precisely determined risk. And now I can see, are there 2 of those at least in either direction? If so, I can take that in either direction. And then the longer this thing monkeys around, I may be able to tighten this up even further as it gets into like a sideways quiet channel, or a Z3 pinch, or best of all, a super pinch. So these little tiny little pinches, the smaller that box is, then the sooner that I can get a large R multiple in either direction. So I have us at 8 o'clock. That's the answer that I wanted to give you to think about. And now I want you to kind of review that and then go back and take a look at the specific question that you have, and then start looking, pick a case study and look at the point where the question occurred to you because you marked it up on that chart and said, that's where the question occurred to me. What should I do? Let me take this approach now to have you frame that trade and answer your question. What do you see on the chart using that frame of reference? Where are the tradable frames? And then that's going to give you the answer to the question the long way around.
Absolutely.
That's going to give you the answer to the question, is there a tradable move to the downside based on your assessment of reasonable moves, manageable risks, and the context of the previous move? Check or hold?
Yeah, no, that's fantastic. Ian, thank you.
Yeah, that's what I wanted to say. So I have us at 8 o'clock. I got to cut it there because I got to finish up the reports because we're starting in a few minutes. I noticed I didn't have the chat box open. I noticed that there's some chats. Hold on. Yeah, Greg asks, why not use average max excursion versus average win? It's not either or. You actually use them both. Because what you're going to do, not just maximum average excursion, what you're going to do is for every trade of a particular frame, you're going to say the first one went this far to the maximum excursion. It went this far and this far and this far and this far and this far. You're going to find the max it ever moved. You're going to find the minimum it ever moved, which is always 0, because it may have started failing right away. And then you're going to find the average max. You're also going to find the average based on your exit rules, because what you also care about is tuning your exit rules to the pattern, because you're actually going to take those 5 different exits. Remember that the maximum favorable excursion is one where you have no exit at all. Or you take the original red line. You take the original red line and say, if this thing made that move and I stay in it until it ever fails there, that's really not helpful. I think you got to do something like probably start off with a trailing 1R and see what happens, or trailing 2R or something. But you start examining all of these different exits, that's going to affect what your maximum excursion is, because each one of these is going to give you a different exit point, and some will get out before the other. So one particular exit may have a maximum excursion there, but if you use a different exit, it might have been here. And then on that basis, you're going to be able to judge for that pattern, for that set of symbols, which one of these exits gives me the best average return. What you want to know is where all of those different thresholds are on your way up that price and performance ladder, but you certainly want to know where your average win was, because you don't ever want a trade that got beyond your average win to fall back below. And if you found your average maximum excursion, you now have the reason to say, oh, this thing is really abnormal. In fact, that's probably, I need to have 2 positions on before I ever even got to that. So that if this thing becomes abnormal, this might be the one that's a runaway train, and I want to have 2 positions on instead of 1. So you can start analyzing the statistics of your performance, but only if you have precision in your rules and you have the ability to trade that system precisely, whether you can follow your own rules or whether you hand that off to a robot. Yeah, what I would say about the Kata 2 is sort of this, that the SSCs, when they work, look magnificent, because you can usually get a really tight stop because you were so close to failure. And if it failed, you love that because you can be short again with a small risk. But if the SSC works, you get this extraordinary R multiple. What you get is a lot of opportunities on Kata 2 on its way up. So on that one, you might get one SSC for that whole run, but you might get 5 or 6 Kata 2s. And each little Kata 2 has a smaller reward, but because you have greater opportunity, you might get better, what we would call expectunity. So you want to understand the relationship between the SSC and that whole family of Kata 2s all the way up. Check or hold? Okay. Yeah. All right. That's everything I got. I got to get the reports done, and you'll hear that as you go through the FAQs and the different. Yeah, you'll hear that stuff repeated in various ways many times, but it's always better to hear it again a new way, and hopefully that one, hopefully I was clear on that one. The more times I explain it feels like I explain it better each time. So keep asking me that question like every week, and about 5 weeks from now, I'm going to have a magnificent answer.
That was great anyway. Thanks, Ken.
Yeah, one of the things I also want to say is that answer that I just gave you, it's impossible to put that into a static slide. It just, there's so many different slides I'd have to show that you can't get the continuity of the analog drawings and some of that. So at the end of it, when you look back at that, you're saying, God, what a mess. But if you look at it a few more times, you start feeling like a cave painting in production, and it helps you build the narrative with the visual and the audio, and you can start feeling your way through that answer until you can draw your own sketch with your own words. Practice that. That's how you really end up internalizing these ideas, is drawing your own sketches. Like when I talk about the water ecosystem, this sketch really speaks to me. The spiritual mountains and the rain, and it comes down and builds the stream, which becomes the river, and then we contain the river with dikes, and then we have a mill that supports all of the agriculture of the people, which we then sell food to the city, and they send us goods and services up the stream. And when I look at my own trading process as production, I realize that all the energy for that is just coming from the spiritual water, and it's just there. And if I just place this right and tune into that always on source, it will drive the wheel for me and do all that work. And then I can support many different farms or different systems with that same analytical grinding, just grinding and making grain and selling that. And as I start maybe formalizing that, I develop an ecosystem approach that talks about plan, prepare, execute, assess, what it means to learn authoritatively. And the process of plan, prepare, and I'm ready to trade. Now I just execute without thinking, and then I assess it. And in execution, I can improve the way I do that by understanding those elements: time, will, pattern, and money, detecting targets and servicing them, using the blueprint of my plan to find probable targets, using emotional control to get into a zero state in order to execute flawlessly, and then manage the trade in the same way that we just described if I was just going to put words on a page. And then I'm going to use all of these elements of mindfulness to ensure that I have affirmative steps towards managing my professional emotions. I'm going to have accountability partners and a personal learning journal and periodic coaching calls to check myself. I know who the different parts of my internal management team are and what they do for me, and I can recognize which voice is talking in my ear and make sure it's the right guy at the right time. And I have business processes that are designed to help me make incremental improvements on mechanical systems using statistics like the industrial engineer that I am. And I can use art, science, and craft knowledge to help me, and that I can use sensible deployment strategies to start with new systems and just back test them, paper trade them, prototype with small scale, do limited rate risk, and then grow into full production when it's proven itself in forward trading. And that if I keep my strategic self, my identity, my purpose, my mission and values aligned with the way I do work and then the way I make tactical decisions, I have a chance of staying aligned with who I am as a person. All of those things represent the rational components, the compartmentalized components of an ecosystem, which in my heart feels like this. But if I was going to make a scientific formal study of those components individually and then array them, it might look like that. And then all of that is simply to have the ability to take a look at my performance statistics and say, what is my win rate over here on the side? And then what is my average win to average loss and my win-loss ratio? And I know that if I have something like a 50% win rate and I can have a 3-2 payoff, then I'm going to have a 0.25 expectancy and I'm out of the neutral zone. I can actually make a living on that. I want to be in the green and I want to be up and to the right. But I have to get out of this no man's land where it's really tough. If I'm in the red, I cannot be trading that at production level. But I can make improvements to start moving up and to the right. And so I use this not only as a reference sheet, but also as a reminder that my central governing process as a trader is to be a mechanical engineer controlled by statistical process control in order to prevent my internal chimpanzee and intuitive artistic self from grabbing control of the machine that makes the difference. And to me, that's where my edge is, I believe, is the ability to have that as my guiding assessment. The numbers don't lie. The other things are important parts of who I am, but I never lose sight of this. That's why the statistical approach to trading is so strong as an internal guidance to me. That's my internal guide. No other voice.
Great.
That table. So that's what I wanted to say. Now, if I've got that done, how do I make improvements? That's where on down the road, when we start talking about the creativity course, I can start taking a look at how surprising and novel are those things and compare it to how, is it affordable? Does it violate my values and beliefs? And I can start evaluating these spontaneous ideas that come out of nowhere. I can always go back. Now I can start gathering statistics and data to characterize or to grade those things. I want B or better before I start committing real money to it. Okay. So more on that. That's in the creativity course. I'll talk more about that later. But now I really got to go. It's 8:11. I got 19 minutes to get to to get the reports done. All right. Cheers.
Good night.
We'll see you soon.